Right, we've just ticked past 9 o'clock AM in the UK here. And so welcome everyone to BDO's webinar focused on professional services firms. My name is Anna Gerald. I know I've met a number of you before, but I'm a tax partner focused on advising professional services firms. For those of you who don't already know, BDO is the world's 5th largest accounting network, providing auditing, accounting, taxation and advisory services in over 160 countries. We've been long-standing advisors to the professional services industry in the UK and worldwide, and our UK national PS team is one of the largest dedicated sector teams within a UK accountancy firm. Through our exceptionally strong focus around the sector, we work with a full range of clients from boutique firms through to large international businesses, including partnerships, privately owned corporates, listed, private equity backed businesses, the full range. So we work regularly with our overseas colleagues, and today we'll be updating changes happening in the Netherlands tax arena and law. So our speakers today are Frederick Boulogne and Rami Mohammed, sorry.
Mohammed, yes.
Frederick is a tax advisor at BDO in the UK. Sorry, in the Netherlands. That would be a bit of a sort of interesting point if you were going to cover a Netherlands tax. So Frederick is a tax advisor at BDO in the Netherlands. He advises on Dutch tax law and international tax structuring matters, advising on a broad range of predominantly US and UK headquartered clients, and certainly some of my clients have benefited from your input. Frederick holds a master's degree and a PhD in tax law and lectures in international tax law at the University of Amsterdam, regularly publishing in this field. In 2017, Frederick, you won a major academic prize given by the European Commission, so congratulations for that. I know, Frederick, you use a mix of analytical, creative and interpersonal skills to provide robust advice, and also use those skills to definitely dig people out of trouble when they're in it. So Rami Mohammed is a senior legal counsel at BDO in the Netherlands. You advise on employers on a wide range of subjects such as collective dismissal, employment conditions, illness and rehabilitation, collective labour agreements and international employment law. Rami is involved, clear and decisive without losing sight of underlying relationships and interests. They're very practical in approach. In addition, Rami is also responsible for collecting, developing and sharing employment law knowledge, both within and outside of BDO Netherlands. We will cover a broad range of subjects today. So on the tax side, we'll be talking about setting up common foreign partnerships, the tax classification of UK LLPs in the Netherlands, and the changes that are afoot in relation to personal service companies. We'll be adding to that the legal updates and picking up any questions that we have at the end. So as always, we encourage you to ask questions during the webinar. So we are doing this live, so please do use the benefit of that using the Q&A feature, which should be at the top of your screen. And we'll pick up as many of the questions as we can at the end of the webinar, or if time doesn't permit after the session. So we're going to finish within the hour. So as always, we'll record the webinar and we'll share with you the slide deck, as well as a link to the recording in a few days. So first up, Frederick, it's over to you.
Thank you very much, and good morning to the audience. Thanks for joining at this time of the day. There are 3 topics indeed I'd like to address, starting with how partnerships, professional services partnerships are commonly set up in the Netherlands when they do business here and start working on Dutch clients. The next slide, please, Jade. In a very basic structure, for instance, a UK headquartered LLP partnership with UK or foreign partners could simply start and register here in the Netherlands with a branch and start conducting business. From a tax perspective, this is a relatively straightforward and quite common setup, and I just want to talk you through the basic key notions in doing this. So by being a partnership, which in this setup would be a transparent partnership, the foreign individual tax partners would become liable to individual personal income tax in the Netherlands for reason of the partnership conducting a business in the Netherlands. And this would not only apply to those partners who are specifically tasked with carrying on the Dutch activities, but it would even apply to a partner with a specific UK focus who would still be drawn into the Dutch tax system for being part of a partnership conducting a Dutch business. So this means that in theory, all the partners in the partnership would have to register for personal income tax purposes, which of course from an administrative point of view is quite a burden. There are some tax aspects, of course, which might be favorable because there would be so many partners who would be seen to carry on a business here in the Netherlands. All of them would be subject to typically a relatively low, benign personal income tax rate in one of our lower brackets. Unfortunately, for many of the UK partners, this would not really benefit them because the benefit of a lower bracket in the Netherlands in the personal income tax would be outdone by a probably the higher personal income tax bracket in the UK, and the fact that they would only be able to get a credit instead of an exemption for the Dutch income. So from a tax perspective, they would still ultimately be taxed on effectively UK tax rates. The mirror, of course, of this setup is the effect on the Dutch partner who would become part of this partnership to carry on the Dutch activities. She or he would become subject to a full domestic tax liability in the Netherlands, but would get an exemption for the part of his or her income that is attributable to the UK activities. And in turn, what I'm expecting typically, because the Dutch partner would be a partner in the UK partnership, she or he would also have to register in the UK for being a foreign partner there. This is still somewhat favorable for the Dutch partner becoming part of this partnership, because perhaps she or he might benefit from the progression in the UK income tax rates and only be taxed on in the first bracket. And this effect would de facto not be taxed away in the Netherlands, because we would be giving an exemption of the partner income in the UK. So it's somewhat favorable for a Dutch partner to be part of a partnership with multiple activities in multiple countries, because we would only progressively tax the Dutch income of that partner and not necessarily the part of his or her income that is attributable to the other countries. So it's a relatively, if this partnership is transparent from a UK perspective, transparent from a Dutch perspective, it's a relatively straightforward setup. With one issue, everyone has to register for personal income tax in every jurisdiction where the partnership operates. The next slide, please, Jay. What we are therefore seeing in practice as an alternative is a international LLP, or specifically a Dutch LLP, being formed for this purpose, with the effect that the number of partners who potentially have to register in the Netherlands as taxable partners can be significantly lower. So you could have a main UK partnership with 50 partners, but only set up a specific Dutch or international partnership with a couple of partners, including, of course, the Dutch partner running the business in the Netherlands. The benefit here is clearly that the number of partners that has to register would be far lower. And what we are seeing, there are quite some options in the end to attribute profits among the different partnerships. Of course, with one important, let's say, one important parameter, in the end, what the profits that can be attributed to the activities carried on in the Netherlands must be taxed somewhere by someone. So you can divide them among as many partners as you'd like, as long as ultimately those profits are taxable here. And this is quite a flexible system, which gradually, by introducing a number of valve partners, can even allow for growth of the Dutch partnership. So this is a very workable solution. An alternative option that we are seeing is, instead of a partnership, a second partnership coming in, that the main LLP would set up a limited liability company here in the Netherlands, and potentially the Dutch partner simply becoming a partner in the liability company. In itself, that is also a very straightforward approach. The activities here would be ordinarily taxed with corporate income tax at a somewhat lower rate. The partner would be taxed on income distributed from that partnership. And yeah, the issues in that case to be considered are particularly withholding taxes on distributions from the Dutch limited company going to the partnership. That would be the critical issue. And this is something that has to be aligned with the Dutch tax authorities. But again, this is also a very straightforward setup in the Netherlands to use a limited liability company in this regard. The next slide, please. Do I get a nice question? Do you get relief at source if there is a treaty rate? Yeah, it's a bit hard to get into a chat. Let me consider the question. Relief at source is a term a bit alien to our Dutch tax law. If it's relief at source of Dutch dividend withholding tax, my answer would be this is really something to be aligned. Technically, we would see UK partners having a direct interest, UK individuals having a direct interest in the Dutch limited liability company through the LLP, which typically does not entitle the partners to a reduction of dividend withholding tax. But in some cases, we have found that tax authorities are open to discuss this, particularly when there is a legitimate business carried on in the UK partnership. But it's a complicated topic, and if there is no relief, of course, the alternative is getting a foreign tax credit at UK partner level for the Dutch withholding tax withholding. I think, Anna, I see you nodding a little bit. I think that should be an option in many circumstances. Going on in the flow of things to the classification of the LLPs. So in the previous couple of slides, I was portraying the UK LLP as a tax transparent partnership, which made all the effects quite simple. This is not as straightforward as it seems. The reason is that the LLP is a particular UK, perhaps US, Canada based type of legal form, which is alien to our Dutch corporate law, for having a mix of both a partnership, which typically is transparent, and at the same time limited liability, which typically is something that is more akin to corporates. This mix also makes it therefore quite difficult to characterize the LLP as transparent or non-transparent, because it bears the identities of both. The typical approach to classify the LP under our current Dutch income tax rules, based on a certain decree, is looking at 4 particular tests that can all be answered by looking at the LLP agreement and by looking at the law that governs LLPs in the UK. The combination of the two would give you the answers in every particular LLP, whether it would be transparent or not. What is usually, I think in any case, without doubt, is that an LLP is able to have legal ownership of assets, which is a yes here. What is a bit more doubtful is how the term limited liability must be interpreted here. And we have seen 2 lines of thought. The first one being the starting point of the LLP being limited liability, and every potential liability for a partner that could arise is a mere exception to that main rule, for instance, upon misconduct. A second line of thought would say, well, this limited liability must be a full limited liability. So the fact that in some circumstances a partner could still be held liable for some of the liabilities of the partnership indicates that this is not a full liability, full limited liability. And we have seen these lines of thought being developed, being somewhat interpreted differently by our courts. What is quite clear is that an LLP does not have a capital divided into shares. And then the combination of the answers to questions 1, 2, and 3 would fundamentally bring a lot of pressure on the fourth clause, which is the tradability of the partnership interests and partners being able to be admitted by the partnership with or without consent by all the partners. And this is a very tricky point. If you are an LLP with 3 partners, you would commonly expect all 3 of them to have to approve the admission of a new partner or the replacement of an existing partner. Where this, of course, is a partnership with 100, a law firm with 100 partners, there would be bodies that would be responsible for the admission of new partners and perhaps a majority vote in the partnership meeting. I cannot imagine that there must be complete unanimity among all partners in a large partnership for the admission of a new partner. That typically doesn't work this way. While this is the strict test to be applied in our law. And this puts therefore a lot of, let's say, pressure on this question, on the interpretation of this clause. If every partner should approve the decision of admission or replacement of a partner, it will be transparent. If some partners could decide against it, but the partner would still be admitted, and typically it's seen more akin to a non-transparent partnership. It's more non-transparent from a Dutch perspective. So as you can see, these tests, particularly liability and admission of partners, do not always, are not very clear to answer in the context of a professional services LLP with a large number of partners. The next slide, please. So as I mentioned, if there is a combination of limited liability ownership of assets and it's not carried on for the account and risk of the partners, it would be a non-transparent beast. What is account and risk of partners, which is somewhat of an additional test? It means that the partners are directly entitled to the profits of the LLP, meaning there is no requirement to have a separate profit distribution as you would have with a limited liability company, but the profits would in theory automatically flow to the partners once, of course, the CFO signs off on the profit distribution and the number of the profits. I would argue that this part is definitely reasonable to say that this is common among most professional LLPs, that it's merely a matter of completely calculating the total profit and then applying the system, the partner point system, and distributing it among the partners. Anna probably knows that maybe in BDO life in the UK as a UK partner, it might be somewhat different and lots of complications can arise. But if we want to get to a transparent classification, this is what we argue, Anna. And I would say that they are directly entitled to the profits.
Understood.
Yeah. Then what we have therefore also heard from tax authorities in some of our discussions is that professional partnership LLPs under current rules can be seen as tax transparent under the guidance I just discussed here. What doesn't really help us is a Supreme Court case that came out exactly a month ago, the 15th of July, where the Supreme Court upheld a decision by the Hague Appeals Court that a LLP was non-transparent. My take on it is this was a very particular and abusive case by the taxpayer who clearly sought to take benefit of one particular income tax rule. And I would argue, and I have found some other tax inspectors also following this view, that this case, considering a 2-person LLP carrying on a travel agency should not have a spillover effect on professional services LLPs. So don't worry, guys in the room. This decision is not that relevant. Then finally, future law is going to bring a couple of changes, which I really hope should not affect the LLPs in the Netherlands that much. We will see foreign managed LLPs with a UK headquarter, for instance, to be classified similarly as they are classified in the source state, so in the UK, which means that there is no chance of a different classification of that partnership. They would be transparent. I think that is a very clear rule from our legislator that we are expecting, which would always avoid a mismatch in the classification of the LLP. What is a bit more, let's say, difficult is that a Dutch managed LLP, which is very strange theoretically, would become non-transparent per se. So the classification of an LLP would depend on whether it's managed from the UK or whether it's fundamentally managed from the Netherlands. This, I think, looking at this, if a LLP is setting up an LLP particularly to carry on business in the Netherlands, it then makes sense to include a couple of UK valve partners, particularly those that I think have an important role in the partnership, leading positions in that partnership. I think you can then argue that it's still a foreign managed LLP.
Okay, so some things to work through there, Frederick, when those changes come through in January 24.
Yeah.
You've also, so that's, all of this information is really helpful when you're setting up a new structure so that you can understand what the future is going to look like. What happens if you've got an existing structure and actually one might look transparent or opaque now, and it's going to, under the new rules, it's going to change its classification?
Yeah.
Is there going to be a tax charge on that change, whichever way it goes?
Yeah. Unfortunately, a draft proposal of this classification rule completely ignored the tax consequences of a conversion from transparent to non-transparent or the other way around. Even though we would expect this to lead to an exit tax, either in the income tax for the partners or in the corporate income tax for the partnership, if it was non-transparent. And that, of course, would be somewhat problematic because it would require you to tax goodwill that was built up in the partnership, potentially any profits on accounts that you have not taken yet, etc., etc. So there must be in the new rules, there should be and there must be grandfathering rules to guide this transition. And I really hope that the proposal next year will offer these rules. I can assure you, BDO, the other competitors of ours, the industry bodies, have spotted this point and have upon the consultation by our ministry, have made this point very clear.
Yeah, okay. So let's watch this space in terms of what they're going to do about it. Okay, and then that's the sort of looking at the UK LLP side of things and, you know, what changes might be happening there. Do you also see other structures being used in the Netherlands? So, for example, maybe a corporate subsidiary or a local Dutch partnership, rather than sort of the what we're talking about here?
Yeah, definitely. We see Dutch limited liability companies or cooperatives being used in the Dutch sphere. The benefit sometimes of a cooperative is the ability to avoid dividend withholding tax on distributions to the partners, and in some cases ensure participation exemption for the personal holding companies.
Yeah.
Those entities would be quite simple in their maintenance. They are subject to Dutch corporate income tax at a maximum of 25%. These changes in classification should not affect those structures that much. Yeah. So they will remain normally taxed companies. And this indeed is an alternative because it's these are legal forms much more embedded in our legal system and therefore more easy to manage. I would say. Yeah.
Okay, great. Thank you.
The next slide, please. So the consequences of the differences in classification, there are definitely some consequences. And I mentioned consequences of a conversion from transparent to non-transparent. That would be very tricky point. But let's just assume there is a partnership and it is characterized in a certain way. If it's transparent, again, we would not tax the partnership as such. We would be taxing the partners with personal income tax, which in the Netherlands goes up to 50% personal income tax, quite high. At the same time, in our exemption rules for foreign income, we would exempt foreign income of a Dutch partner through the partnership carried abroad with progression. So exempt the foreign income, but still apply the progression in our Dutch rates to the Dutch income of that partner. If it's non-transparent, the partnership from a Dutch perspective, but it would be an LLP, for instance, which is transparent from a UK perspective, we would then tax the entity in the Netherlands with personal income tax. We would subsequently, upon a distribution to the Dutch partners, tax them again with personal income tax. This is an ordinary distribution. And you would see the 25% and roughly the 26% more or less align with the 50% in case of a direct partnership. So there is some alignment in the rates there to achieve the same effect. What would be quite difficult is if the Dutch partnership has carries on a business abroad and has foreign partners, that it's quite difficult to exempt the foreign profits realized by that partnership when abroad it's the individual partners who are each assessed for their share in the partnership. So we would see a partnership being taxed as a company. The other country would see a group of individual partners being taxed with income, personal income tax. And that misalignment also creates technically a misalignment in our exemption rules with, I think in theory, the risk that the profits earned abroad would not be exempt in the Dutch partnership. This is also something I hope that is going to be addressed in the new rules that we are expecting. So I think as a conclusion on this point, a mismatch in classification of the LLP really poses some difficulties, and we must therefore monitor very carefully what the proposal is going to look like. Then maybe finally, my next topic of the use of service companies, personal holding companies by Dutch partners in the partnership. The next slide, please. For Dutch partners in law firms, consulting firms, accounting firms, it's extremely common to not be a partner directly in that partnership, but be a partner through a personal holding company, service company. And typically what we saw is partners conducting business through a two-tier structure, a personal holding entity, personal work company, that in turn becomes the partner in a partnership. That of course is possible, and it gives a couple of benefits. It really ensures, I think that is the idea at least, protection from liability by the partners, because the business of the partnership, the accounting business and some kind of accounting scandal or so, should not fundamentally affect the personal holding company. I guess that probably holds true unless you're completely malignant and grossly misconducting. In that case, it's probably possible to go after the individual partner as well. But typically, upon a normal performance of your job, you should have an extra layer of protection from the risks in the partnership. Partners also liked it because it is a separate vehicle. They would have that allow them to do some estate and retirement planning, perhaps buy a home, etc. Sometimes buy the home without being visible, who owns the home, etc. in the public registers. From a partnership perspective, this was also seen as a simple solution because it reduces the risk that the partnership is considered an employer of the partner. So let's say at some stage, an agreement with an individual partner would be terminated. It would then reduce the risk that this partner could successfully say, I was always an employee for the last 25 years and I want to receive all kinds of benefits. So there are a couple of advantages. The largest advantage that has driven these structures was tax. The next slide, please. Because it allowed these structures allowed and still allow for a number of benefits. I'm taking here the example of a transparent partnership, who in this case would be, if it's a transparent partnership, would simply mean that the work co that is technically the partner in the partnership is taxed on the partnership profit with corporate income tax at the level of the work co. If it's a non-transparent partnership, which is, for instance, BDO's case, what we are seeing, it's a mix of a management fee being paid to work co, and at the end of the year, a dividend being distributed to the work co. So it's a setup that works in both options, transparent or non-transparent. Typically, the partner would be on the payroll of the work co and would be required to pay himself or herself a usual wage, which is linked to the share of profit of that partner. So that's typically a relatively high usual wage for partners in law firms, accounting firms, and the like. What finally is done at this moment to a large extent is the funds being paid to the partners, to the personal bank accounts of the partners, and therefore the partner having a credit with his or her personal holding company. The effect in this case is that there was no dividend distribution from holding to the partner, but merely a loan. And this means that you are essentially deferring income tax until the receivable would be distributed by the holding to the partner. And as long as you're not doing this, you're merely taxed on a relatively low amount of interest on that loan. This, of course, allows the partners to buy a nice home, a car, a second home, and etc., etc. I think in moving to my next slide, in this particular arrangement, you can see this is an arrangement that is giving rise to a lot of public debate these days. Tax authorities, politicians are accepting that shareholders of companies are lending to themselves instead of distributing a dividend, that it should in some ways be acceptable, but not when that is done excessively. And we have seen years where these amounts would go up to a couple of million euros, sometimes, in some cases being used merely for consumption by the partners. And that, I think, raised a fundamental discussion. Was this a dividend? Should this have been a dividend distributed to the partner instead of a real loan? Because which bank or financial institution would lend money to someone merely for consumption? That's not very common in these setups. So we have a proposal that is going to enter into force next year to prohibit excessive lending from the holding company to the partner. It would be kept at 700K. Everything above it would be deemed a dividend, subject to income tax. At the same time, we are seeing a lot of studies that are coming out showing a rising inequality in the Netherlands. The tax system that we have being seen as less progressive than we hoped, and redistribution not coming through the tax system, but rather through non-tax measures. Finally, we are seeing a discussion on partners. Are they really entrepreneurs, and should they benefit from some of the rules that I just highlighted? Or should they de facto be seen as employees with their profit share being taxed directly against the progressive income tax rate? And finally, we are seeing a proposal that has just been released to introduce a progressive income tax on dividends from the holding companies. That brings me to my last slide. Not this one, maybe the next one. I'll just skip this one in the interest of time. We are expecting some proposals. That would potentially increase the income tax rate, the direct income tax rate for partners compared to the structures that they would now have in place. From a partnership perspective, you could say this is largely an affair that would affect merely the partners themselves, their individual affairs. But to the extent some of them have already done these arrangements in the last 15 years as a partner, it could definitely create some pressure on their personal affairs. and therefore potentially, let's say, the wish to extend their tenure as a partner by a couple of years, some pressure on the partnership profits, etc. For partners who are still at the lower, let's say, the lower part of the salary scale, we are seeing a trend that many of them, also part of the younger generation, may prefer employment when the tax benefits in these income ranges disappear, may prefer employment to becoming a partner. And for doctors, we are seeing that some of them indeed have shifted away from a partnership model to an employment model, simply because the tax benefits would no longer be there. And yeah, then we've combined with the wish sometimes to work part-time, etc., a employment model might be more attractive. Finally, Rami, just finishing last point, Rami will comment on the employment discussion, where we are also expecting some fundamental decisions here.
Yeah, and Frederick, any indication of timing on all of these changes that might be coming through?
Yeah, it could be very soon. So within the decision on employment is expected this year. Changes in tax rules can be expected within 2 years.
Right. Okay. Well, that's very clear. Yeah. And we're seeing this elsewhere, and so places like Belgium and the UK have been through a whole heap of sort of analysis and changes to do with personal service companies as well. So it's certainly topical across a number of different jurisdictions. So thank you very much. Okay, we've got some other questions in the chat and things that we'll look to pick up at the end after we give Rami some space. And then if we can't pick up those questions, then we'll go back to people directly. Thank you very much, Frederick. Rami, over to you.
Thank you very much, Anna. Thank you for inviting me to discuss some employment law updates, and welcome to you all. My name is Rami Mohammed, and Anna already introduced me at the beginning. And I will start with 4 topics which are of interest for Dutch employers or employers who have Dutch employees. So the first one is the EU directive on transparent and predictable working conditions, which had to be implemented as from the 1st of August in all EU countries, and is also implemented in the Netherlands, which forces employers to provide information to employees, some new types of information, and also grants employees some new minimum rights. So just to cover the basics with regard to the information obligations, employers with employees with unpredictable work patterns, for instance, on-call employees, they must agree with those on-call employees regarding reference days and hours, during which or on which they may be called upon to perform work. So the current practice where an on-call employee can be called upon at any time is no longer allowed. You have to agree in advance on those reference days and hours where you can call upon the employee to perform work. In addition, if you are obliged to provide training to an employee, you must inform the employee that the employee is entitled to that training. And you must also inform employees regarding dismissal procedures and dismissal requirements. So you must inform the employee which dismissal procedures and requirements are applicable, for instance, from the Dutch civil codes, or maybe because some regulations have been implemented in a collective labor agreement. And finally, the identity of social insurance institutions. So if as an employer you provide pension or some type of insurances, you must inform the employee the identity of those social insurance institutions so that the employee knows where to go to for those benefits or allowances. So a little bit of more information to be provided by the employer ultimately 1 month after the start of the work. So it is important to adjust templates, contracts, and employee handbooks to these new requirements. In addition, there are some new minimum rights for employees. First of all, the right to refuse work outside of those reference days and hours, as I mentioned before. Second of all, the right to request more predictable and secure working conditions. So employees in the Netherlands since the 1st of August of this year now have the statutory right to submit a request for more predictable and secure working conditions. You can think of a permanent employment contract, for example, or a fixed working schedule. So an employee may submit such a request, and the employer has a duty to consider that request and a duty to respond in time. So for employers with more than 10 employees, that means responding within 1 month. And it is very important to do so, because if you fail to respond in time, if you fail to decide in time on the request of the employee, then the request of the employee is granted automatically by law. So if the employee, for instance, would ask for a permanent employment contract and you fail to decide on that request, then the employee would be entitled to a permanent employment contract. So it's very important to have a structure in place to process those requests timely. Thirdly, the right to perform ancillary activities unless a prohibition is objectively justified. Currently, the practice is that almost all companies have a clause in their employment contract whereby ancillary activities are prohibited unless the employer grants permission to perform those activities. What has changed is that in principle now ancillary activities are allowed unless a prohibition is objectively justified, and that is not the case very easily. So there has to be really there's a high bar to be met to be able to prohibit an employee from performing ancillary activities. One of the examples that has been given by the legislator is, for instance, when an employee exceeds the Minimum Working Hours Act by having 2 jobs. That could be an argument to prohibit those ancillary activities. And finally, the right to receive mandatory training free of charge and where possible during working hours. So if there is mandatory training that has to be offered to an employee based on legislation or based on a collective labor agreement, that training has to be offered free of charge and where possible during normal working hours. So it is no longer possible for that mandatory training to agree to a study costs agreement whereby the employee has to repay the study costs if the employee leaves employment within a certain amount of time. So it's very important to keep that in mind, that mandatory training has to be offered free of charge. And this also applies to study costs agreements that have been concluded before the 1st of August of this year. So if you have an agreement concluded before the 1st of August that sees to mandatory training, you are no longer allowed as an employer to demand repayment of those study costs. So also at this point, it's important to look into your company policies with regard to training and study costs to make sure that is in line with this new legislation. So those are some highlights regarding this EU directive. Moving on to the next slide, please. We also have paid parental leave as from the 2nd of August of this year, which means that working parents are entitled to a benefit for 9 of the 26 weeks of parental leave, which must be taken within the first year of the child's life. So for those 9 weeks, the employer can apply for a benefit on behalf of the employee at the Employee Insurance Agency, the UWV in the Netherlands, and can forward that benefit to the employee for those 9 weeks. The benefit is also available for parents with an adopted or foster child, and the 9 weeks will have to be taken in the first year after the child is being taken into the family. The benefit is 70% of the wage, up to 70% of the maximum daily wage, which is a little over 5,000 euros per month. So it's very important for employers to keep in mind that they will have to request the benefit on behalf of the employee at the UWV, the Employee Insurance Agency, and to do so in time. This has to be done or can be done after the first week of leave, but has to be done ultimately within 3 months after the child's first birthday. So it's important to keep that timeline in mind as well. With regard to the employee has to give notice of his desire to take parental leave at least 2 months in advance. Now, the employee can spread that leave in principle as he or she would like. So he could request the parental leave to take it for 26 weeks ongoing, or for 1 day a week, for example. But the employer can change the spread of that leave in case of compelling business or service interest, which could be the case, of course, if the employee wanted to take a half year off parental leave.
Yeah, and Rami, these changes coming in since the 2nd of August this year.
Mm-hmm.
What happens if the child was born prior to that date? Do all of these still apply, so you can still benefit from this?
Yeah, good question. Sometimes legislation, you just miss the boat, so to say. But in this case, also parents that have a child in their first year of life can benefit from this arrangement. So they are entitled to the paid parental leave as long as it is taken in the first year of the child's life.
Okay.
Yeah. So that with regard to paid parental leave. Moving on to the next topic, the Working Where You Want Act, which is a great name for a new piece of legislation, which has just been passed by the House of Representatives in the Netherlands and is taken into consideration by the Senate in September of this year. We expect this act to pass the Senate as well, so it is definitely something to look out for as an employer. This act basically grants employees the right to request an adjustment of the workplace under 2 conditions. The first is that the interests of the employee should outweigh the interests of the employer with regard to the adjustment of the workplace. And second of all, the workplace should be located in the European Union and should concern the home address of the employee or a suitable workplace from which work is usually performed for the employer. So basically, usually that would be another office of the employer. So if those conditions are met, the employee can request adjustment of the workplace, and the employer must grant that request unless the interests of the employer outweigh the interests of the employee. So there's a balancing of interests there, and what are interests that are relevant here? Well, for instance, personal circumstances of the employee. If the employee is, for instance, moving, or maybe a change in the family situation could spark a request for adjustment of workplace. But also an employer, of course, could have some interests such as social cohesion, to have employees at the office once a week or a couple of times a week, team collaboration to get the work done in a correct fashion, or maybe administrative or financial burden when the employee is working from another location. So those are all interests that you will have to weigh as an employer. And in this case, also you have a duty to consider and to decide on the request of the employee.
Yeah, Rami, this is obviously really topical. You know, the pandemic created a huge number of different ways of working and different thinking in, you know, partners and employees. You know, we saw all sorts of things with people getting stranded elsewhere and not being able to get back. But now people have got more choice. Could somebody just move somewhere and then ask the employer to say, well, I'm now submitting a request to work from my new home? Would it have to be granted in that situation?
Well, if an employee, for instance, would move abroad, then I think as an employer, you would definitely have some compelling interest to say, well, I'm not going to grant such a request easily, because that would have a lot of fiscal and also legal consequences. For instance, the country where the employee would be moving, the employment law of that country could also become applicable to the employment contract. So that would have major consequences for the rights of parties in the employment contract, in the employment relationship. So that would definitely, in my opinion, constitute compelling interests from the employer.
Good. So everybody on this call can see, you know, sigh of relief, I think, on the basis, because it's complicated, as we know, as people move around the world, and the sort of the broad tax consequences. Great, thank you.
But it's important to keep in mind that these requests can come as from next year, I expect, more often.
Got it.
And then finally, the final topic is with regard to something that Frederick also mentioned earlier. We have a big debate in the Netherlands, not only from a fiscal point of view, but also from an employment law point of view, between or regarding the defining line between employees and self-employed persons. One of the companies that has been at the forefront of that discussion is Deliveroo, which has also recently stated that they will be leaving the Netherlands, maybe because of this discussion, who knows. They have been in court a lot lately with Dutch labor unions, because they decided already back in 2018 to replace all their employees with self-employed persons. So all the riders in the Netherlands of Deliveroo are self-employed persons, and Dutch labor unions are basically saying that's a false self-employment. These riders are actually employees and should be granted protection under Dutch employment law. So Dutch labor unions are already up to the Supreme Court, have won at both the Cantonal Court and the Court of Appeals, which have concluded that these riders are in fact employees. And now the Advocate General at the Supreme Court has also said that these riders should be considered employees, most importantly because they are part of the usual business activities of Deliveroo. So they are working for Deliveroo as part of their usual business activities, and that is in the opinion of the Advocate General a strong indication that these are employees. Now, the whole discussion with Deliveroo has inspired, so to say, other self-employed persons to say that they might be an employee. One equity partner of Deloitte is now in the news, going against Deloitte, stating that after the termination of his services contract, that he in fact was all these years an employee, even though he was an equity partner at Deloitte. The Court of Appeals in The Hague earlier this year said, well, not so fast. You were in fact an entrepreneur, had your own personal holding, and no salary entitlements. Your payout was totally dependent on the profits of Deloitte. And also you had a lot of authority as a self-employed person to reject clients or to accept clients. So there was really an entrepreneurship there for the equity partner. But there's also an example where you see that a lot of self-employed persons are now trying to become an employee, so to say, to get the protection from employment law. What is good to know is that the decision in the Deliveroo case from the Supreme Court is expected in December of this year. So we hope that that will give more guidance how to approach these kinds of discussions. But this is definitely a hot topic now in the Netherlands. Please know that we have a checklist that you could ask for that has a number of questions which might indicate if a self-employed person might in fact be an employee. So if you would like that checklist, please feel free to ask for that.
Great, thank you, Rami. Now we've got a few minutes left and a number of different questions. So we'll perhaps try and rattle through these and we'll pick up the ones that we can't cover separately. So Frederick, a couple for you. In relation to the changes that we were talking about occurring in January 24, could that affect the equity or the equality, should I say, among the different partners? So those that are based in the Netherlands, those that are based on the UK, will it change things between the two of them?
Well, it would definitely increase. I think in any proposal would increase their direct income tax, their income tax liability. So their after-tax salary would be less. If this is a factor in the partnership profit distribution, so you're taking into account things as cost of living in the city, cost of schools and the like, if these matters are factored in the amounts of profit distributed to a UK equity partner and to a Dutch equity partner, this is something probably to consider, because in the end, it's the net salary that you have that would allow you to do all these things. Yeah. So it's something to consider in those calculations.
Yeah, so it's sort of about revisiting the situation that you've got if you're affected by these changes.
Yeah.
And to make sure it still meets the needs. And it's sort of similar sort of question, but some businesses are working more and more towards using global profit pools so that they feel like they're one business, no matter where they are in the world. And so how will the proposed changes affect that concept of, you know, global profit sharing? Does it make it more difficult or easier to use a single pool for profit sharing?
I think it would make it a little bit easier, because the partnerships that are seen as partnerships abroad would be seen as partnerships from a Dutch perspective. That is clear. So no longer any mismatches. And that, combined with the progressive exemption that I discussed at the beginning of my presentation, probably allows for an incentive to make someone part of a global profit pool, and therefore have different businesses in different countries where the partnership operates.
Yeah.
This, I think, with the progressivity typically in those countries, would allow for a very benign taxation of that partner. It's somewhat complex from a calculation perspective, but there are, I think, some very strong financial rewards if you can capture those benefits.
Yeah. Okay.
Yes. Yeah.
So useful to step back and reconsider what you've got to see if you can take advantage of the situation or how you might tweak things effectively.
Yeah.
Okay, there's a couple around service companies, so perhaps I'll pick up on a couple of those. So do you see any risks for the firm, from a firm perspective, with all the changes that might be coming down the road in relation to service companies? So we talked a bit about the individuals and the impact on them, but what about the LLP or the partnership itself?
Yeah, I think Rami clearly mentioned the risk that at some stage, particularly perhaps for a junior partner or someone with less authority in the partnership in managing his own affairs, there's probably the risk that this person sometimes could be seen as an employee. That's a risk for the partnership. The tax changes that we are expecting should not affect the partnership, but would really only impact the partners at their level.
Yeah. So there's sort of combined points there. One is that if the firm is treated as acting as an employer, then you're going to have employer obligations, and they're the key things to be thinking about.
Yes.
Okay, and if service companies continue to be utilised going forward, if there's a capital requirement, so you've got the service company, it's required to provide capital into the business. Is there any reliefs available in terms of the interest costs in relation to that?
Yeah, what I'm seeing in the market is most partnerships these days do not want to have large capital requirements anymore. Simply young partners just don't buy it and think it's too risky. Right. So what we are seeing is this is usually a rather small subordinated loan being offered to the partnership by a starting equity partner. A buy-in and payment for goodwill, for instance, which was common up to the 90s, is very, very rare these days. So yeah, typically in the market, a small capital contribution, a small subordinated loan, that is what we are seeing, but probably no longer the need to bring in a couple of million dollars before you start. Okay. That's extremely rare these days.
Okay. Well, just a sideline, in the UK that might shift if there's going to be sort of cash requirements for the businesses and things. So we might see some sort of increase in capital requirements, but similar responses from the partners, particularly if you don't get equal treatment depending on which firm you work for.
Yeah.
There's just one final one, which maybe we can just slip in before the hour's up. So if the Dutch authorities have previously been given a ruling in the past to confirm transparency of an LLP, do you need to revisit that decision and go back to the tax authorities and ask for a refresh? And I appreciate the new rules may mean that this is no longer required, but what do you currently see?
Yeah, if particularly, I would say for a foreign managed partnership where you would have a ruling that it's non-transparent, if that was your objective, and it would become transparent, and the value of that, due to the change in law, the value of that ruling is gone, and you would need to revisit it. For sure, for existing rulings which already have the effect that you would have after the new rules come into play, you can, of course, continue with the ruling, and yeah, it would be akin to the law.
Yeah.
But it's something certainly to consider for every partnership here.
Yeah, great. Well, thank you. We're just on the hour, so I want to say thank you very much to both of you. Rami, Frederick, just been excellent, really helpful, very clear in terms of the changes that are coming down the road and the key things to look at. So thank you to both of you. If anybody's got any questions that's been arising out of this, please do let us know. Send it to your normal BDO contacts, and we all know Rami and Frederick, so we can get that message through if it's relevant for them. And thank you very much for listening, and we'll send you the slides and the recording in a few days. Thank you, everybody.
Thank you, everyone.
Thank you.